it finally had to happen, I suppose, and now it has. Inflation data has spooked the markets. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. We finally got the CPI report to unnerve investors in all of this tariff drama since the beginning of the year. We're going to break it down here and see what it was in these numbers that the markets so disliked, what it means, and what are next steps here. Of course, as ever, we've been watching this story in the context of a disconnect that's emerged between what the markets expect for Fed policy and what the Fed itself has been saying. And today, we have a very emphatic check mark in the Fed's column. And what the markets have done is they've interpreted that information as one might expect, by saying that the rate cuts are probably coming still, just later and more forcefully. So we'll see here what the market response has wrought. Here's the performance across major markets for today. The NASDAQ basically flat, but that undersells the level of weakness. It was, in fact, up at a new record high earlier following overnight news that the Trump administration is going to let NVIDIA have a more free hand in selling to China. So the Mag 7 complex and sort of the AI constellation of stocks and tech in general had a good day. But for all of that, for all of the run-up in the NASDAQ here, we end up with a net, let's call it flat close and be somewhat generous. Because at one stage here, the NASDAQ was actually up by a meaningful amount here. From yesterday's close to today's high, we were up almost a percentage point, 0.8%, and we're closing having erased all of that rally. So quite the downswing here. The S&P for a sort of more catch-all view down almost 0.6%, yields up across the curve, 10-year up 1.2, 2-year up 1.28, oil down, gold down, the dollar up across the board, Bitcoin selling. Fairly classic kind of spooky interest rate environment kind of risk aversion across the major markets here. Gold probably the most impressive of the bunch because this 0.7% swing is quite modest compared to what you might expect in an environment where yields are up over a percent and the dollar is as strong as it is. You might have expected to see gold lose a lot more ground. It ends up swinging lower, but still well within the range that it has occupied basically since late to mid-June. So going back to sort of the overall story here, the 4-week, 3-week range in gold, 3 weeks back and then this week, it holds on this, which perhaps speaks to its resilience in the face of what is a shaky environment for risk sentiment. We get this data today, and it's basically in line with expectations at the headline, 2.7% for the headline inflation rate, just as economists had it penciled in. The core reading a little bit cooler, as a matter of fact, 2.9% versus 3% expected. One might expect this was, for the most part, good news. But when you look at the internals here, a number of things immediately stand out. It's certainly no shock that what you have is still most inflation locked up in core services. No surprise there. Core services is overwhelmingly the largest part of the US economy. Most of the inflationary impetus, or frankly, disinflationary impetus, most of any kind of reflection of the economic growth to price connection should be in core services because it is the biggest part of the overall economy. The thrust for overall inflation dynamics will invariably come from this side of the ledger. But having said that, we are seeing the most significant contribution from goods that we have seen since 2021. Last time that we had something comparable like this, and it's not a lot, it's only 0.13 percentage points here of the whole. It's by no means a large contribution. So if the headline is 2.7, 2.24 of the 2.7 is services. No surprise. But the delta in the change here is much more eye-catching. Notice the headline up 0.3 percentage points. The increase from services, the contribution from services, is up just 0.02 against 0.08 for goods. So the swing in goods, the thrust in goods, is 4 times that what you see in services. And this is really the main situation here. Now, obviously, energy gets you a little bit of an uptick for reasons having to do with spiking energy prices around geopolitical risk, and that's probably a fleeting thing. But that's hardly what is the main concern here. It is this. Because what the Fed has been concerned about the entire time that they've been commenting on the implications of this new tariff regime that we've seen emerge since the beginning of the year and its implications for policy, is that the Fed doesn't know how this is going to go, but historically, you get this jump in inflation from a tariff because what a tariff basically is just a consumption tax on imports. And invariably, what it does is it makes those imports more expensive. Just tax on an extra cost. And that is something that the Fed does not want to extend out into broader inflation expectations, because then all of the progress that the Fed has painstakingly secured becomes challenged. The Fed has, through a very spirited rate hike cycle, the most spirited, one might argue, since Paul Volcker in the 80s, secured a decline in inflation from north of 9% by a hair back down sub 3. So this is not anything the Fed really wants to let out of the bag at all. It wants to keep inflation expectations anchored. And for the most part, it's been successful in doing that. But when you see this kind of a shock start to actually show up in the data like this, as an initial early step, perhaps, foreshadowing more downwind, you start to lose faith in the ability that the Federal Reserve is going to be able to cut rates with any kind of significant impetus this year. And so, indeed, as a response to this data, the calculus for the overall shifts a bit, but really the view for 2025 starts to move into territory where the markets are now less dovish than the Fed's own outlook. As of today, we're down to 39 basis points for this year, but we are out to 68 basis points for next year. In other words, what the markets are saying is that the Fed has less capacity to cut rates this year than even it has accounted for. But that what this will mean, what this delay is going to mean, is that the Fed is going to have to cut more later. In fact, notice where we are here. This setting for the 2025 Fed outlook matches us back to where we were here in mid to late February. And of course, this is where the stock sell-off began around the rollout of the tariffs as they began to spook business and consumer confidence surveys, and the markets thought this whole thing was a growth risk. Note that while stock markets have rebounded since all of that story seemed to crescendo in early April, but policy expectations have been anchored in a range. And the only thing that's changed, if you'll notice here, is there's a lot more gray here than there is yellow. In other words, the markets thought most of the peak 137 basis points in cuts here would come this year and a little bit next. That script has flipped. Now it's most of them are going to come next year because the Fed couldn't move and is right to be, frankly, dragging its feet for this year, according to what the markets now say. Compare that with what the Fed just updated for its summary of economic projections in June, and you have 50 basis points for this year, the median rate now 4.4%, so down to 3.9 is 50 basis points. That's 2 cuts. For next year, as of the latest update, the Fed slashed a cut out of the 2026 outlook because ostensibly it feels like the full tariff impact will take longer to see because of delays in the data and because, of course, the tariffs themselves have been constantly paused and variously diluted. We have another cliffhanger on the reciprocal tariff architecture coming up just next month. And so the Fed is only seeing 25 basis points next year, from 3.9 to 3.6, and then another in 2027, though that's most likely a bit far to really have accurate forecasting. So the market is at this point at 100 basis points. The Fed is at 75. That feels like not the greatest disparity. But then you consider for next year, the market is at 68 basis points, so leaning in the direction of 3 cuts. And the Fed's at 1. And what that starts to say, of course, is that what's going on here is the markets are disappointed. They wish the Fed would go sooner. They've wanted the Fed to go bigger than the Fed itself has forecast. In fact, here was that update in June. The Fed's been on the dovish side of it basically since it came out. But it thinks that there will be an inability to act this year to the extent that they'd like. And so they think there's an exchange rate between rate cuts now and later. And that exchange rate means that for every rate cut you miss this year, you're going to have to do more next year. Not just move the cut in time, but actually do more cutting, because what you'll end up with is a delay that then lets the economy become weaker, and then you have a bigger stimulative job that needs doing. With that, we have another batch of inflation data that's due tomorrow, and while the PPI index, the producer price index, is not typically the most market-moving thing in the world, this time around, we might actually get more action here. In fact, we've been seeing more action here for the past several months. Now, we can see the expectation is that the overall headline PPI will come in a little bit from 2.6 to 2.5. and the core will come in from 3 to 2.7. But where that downswing comes from is tremendously important, because one of the things that we've increasingly noticed here is that weakness in PPI has come at the price of wholesalers giving up margins, giving up essentially profits in order to insulate consumers from tariff-linked inflation. So consider what we have right here. And this, of course, is something that is back to where we were looking here in April's data. It didn't show up in May, but this right here, this major spike down in the trade services component of PPI is telling you that margins are getting squeezed for wholesalers. They recovered a little bit in May, but only a bit. Whereas this swing down right here, as we can clearly see, was the biggest one since back here in COVID times. And so what we end up with then is a situation where we have now the biggest squeeze shaping up on margins since basically recession equivalent dynamics right here. So it's telling us that the resilience we've seen in CPI up until this report really was something of a mirage, because wholesalers were eating the inflation. And while they are perhaps still eating some of it has started to show up in CPI. If you now get a PPI report that's weak, and the reason it's weak is because margins are getting squeezed once again, and perhaps further, well, then all the architecture of an inflationary scare from the tariffs is on display. And from the market's perspective, it was always about the growth implications of that scare rather than inflation expectations. We go back to how the markets performed in the first 6 months of the year. We broke this down granularly last week, but we'll revisit it here because it seems appropriate. What we saw in the first half of the year, for all of the hand-wringing and for all of the concern around what's going on in the U.S. and all the extra risk associated with the tariffs and maybe the Fed won't cut, rates fell in the first half of the year, both at the front and the back end of the curve. And that tells us two things. At the front end, it says the markets are pricing for cuts. At the back end, it says there is no credible sovereign risk, that the market continues to happily buy U.S. government debt and have faith in the U.S. sovereign as a borrower. And so it is not surprising then when we get the kind of performance that we get out of this news and out of this whole story today. We get higher yields and the dollar strengthens. We see the dollar behave as the anti-risk haven type of creature that we've been used to, not the sell America dynamic that appeared in April around the panic linked to tariffs then. And so we get into a much more kind of classic setup here, where if the PPI data is going to reinforce this sense that there is, in fact, an inflation scare, the implication for markets will be, oh, Well, that's probably the one-off, but the follow-on is the growth hit. And that's how you reconcile. We have cuts. There is no sovereign scare. But a cyclical commodity like crude oil, for all of the fire and fury in the Middle East, fell 9.2% in the first half of the year. And in fact, if you unpick the makeup of the 10-year yield here, as we've been doing, into duration risk, that is term premium, how much the markets want to get paid extra for having risk of time, and inflation risk, the break-even inflation component in 10-year yields, we find that since the beginning of the year, break-even inflation is mainly trending lower. In fact, it's been mainly trending lower since the end of last year. Whereas sovereign risk, or at least duration risk, seems to be building. And while it's not a US default type of a thing, it does suggest that the markets want to get an extra compensation for time uncertainty. And what that seems to speak to in the context of this is that it isn't inflation so much that the markets are concerned about, it's growth, which is why they want these rate cuts. They're not so much looking to the concern that inflation expectations might get anchored. They're concerned that consumers will stop buying as prices go up and the economy will start to fade. Hence this exchange rate in rate cuts, where the market is not saying, oh, this data means that we don't need rate cuts because, look, the economy is so strong. No. They're saying we do need rate cuts because the economy isn't strong, but the Fed won't be in a position to deliver it, so the economy will get weaker than perhaps it needs to, and it's because inflation numbers are as they've presented themselves, which suggests then that if the PPI numbers are anything like what we've seen over recent months in their internals when they come out tomorrow, one might expect this layout to continue to hold and perhaps an even more significant risk-off sheen to appear across the major asset classes. And that is Macro Money for today. As ever, we are here right after overtime, show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am going to be back with Chris for Futures Power Hour as ever, Mondays and Fridays, though I believe we're off this Friday. I am likewise writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.